All right. Hello, everyone, and welcome. Thank you so much for joining us for this Accredited Investor Virtual Expo. I'm so pleased to introduce our speaker for this session, Ina Rosputnia, a stock and futures trader, author of the book Basic Instinct of the Trader, and the CEO of ManagedAccountsIR.com. In 2016, she was nominated to the Women in Finance Awards, and in 2019 received the award of Leading Innovator in Wealth Management and Most Outstanding Woman in Finance. To our wonderful viewers, if you could please type any questions that you may have into the live chat box. Time permitting, I'll be announcing those questions at the end of Ina's presentation so that she may answer them. With all that said, Ina, thank you so much for speaking today. If you need anything at all, I'll be right here on mute. The floor is all yours.
Thank you, Charlie, and thank you everyone for coming to see my today's presentation. And today I am going to talk about how actually we can focus the major stock market reversals month in advance. And the good news is, yes, it's possible. Nothing is perfect in this business, but we can come really close. So let's get started. First of all, you have to know that market tops and bottoms in different way. In other words, we can use almost the same set of the tools to focus top and the bottom, but the nature of how top and the bottom is created is absolutely different. Let me ask you a question. Why do you believe markets find a bottom? It's simply because the price is reaching so-called fair value or the value of interest, and then the big money immediately come to the market and we see really a sharp reversal to the upside, and it usually happens quite fast. But the situation with market tops is absolutely different. Markets can be in the top formation for a very long time. And as you likely know, we have a real bear market only if there is a recession. Without a recession, it's only the pullback and the sell-off limited, and it will just create another buying opportunities and so on. So if there is no recession, there is no reason to expect a bear market at all. But more than that, even if we have all the signs of coming recession, it still takes a lot of time for the market to top. And you will see like everything is negative, but market continues to make a new high. A great example of that is the film Big Shot. I believe that many of you have seen it. It's based on a true story about a few traders who managed to forecast 2008 crisis because they noticed big problems in the economy. But it took almost 2 years and they established their positions for the market to start to decline. And that is very important thing to understand and to keep in mind when it comes to tops and bottoms formation. So here is a great example of what we recently witnessed, and it's a COVID sell-off. As you see, we had a lot of negative economic indicators at that time, and moreover, the ADX, which shows an integrity of the trend, was falling apart while the stock prices have been rising. So it's a kind of bearish divergence, and we saw that there is no integrity and no real strength behind this rise. But still, it took almost half of the year for the market to form a top, and then finally we had a sell-off. But the absolutely opposite situation happened when the market found the bottom. We used the same ADX to predict the next reversal. When the ADX is above 40 and starts to roll over, we have a sign of the end trend and beginning of the uptrend in this particular example. And as you see, we got a signal right here, and it was quite a good moment because market started to rally right away. But it wasn't so perfect with the sell signal, and it always be like that. Because when the market finds an interesting value, the big money will come in and we will see the rally. But it takes a lot more time for that negative situation to develop to that level that it just gives away everything. So keep that in mind. You may ask, so what is the best time to buy stock? And it may sound a bit strange for the first view, but the best time to buy is when we are in recession, and recession didn't end it. And also, there are two more factors that can confirm a good buying opportunity. The Fed consumer opinion is 98 all over, and also we have a very high unemployment, which doesn't sound like right thing, because the recession, high unemployment, and everything is so bad. How it could be a nice buying opportunity in the market? And the answer for that is really very simple, because when everything is that bad, the government will step in and the Federal Reserve will step in. And by all means, they will work very hard and they will do their best to get the economy back to the uptrend and to get the stock market back to the uptrend. We may dislike them or their policy, but let's just analyze the fact. They are doing their job not bad, because other way we wouldn't have that new highs almost each year, and the recessions would last much longer time than we have it now. So anyway, they're doing their job. So here's consumer opinion, and you can find this information absolutely for free online. That is another good thing that government is doing for traders and investors. They share a lot of information for free, and that information is extremely useful. So when we have readings below 98, usually we are in the middle of recession, and it's not a great buying opportunity, because the market, as I said, bottoms at the middle of recession or at the end of recession. But anyway, it happens before we see the real recovery of the economy. So keep that in mind. And this consumer opinion helps us with a timing a bit. Not the perfect timing tool, but quite useful. And here is unemployment data. As I mentioned, high unemployment is bullish for S&P 500, while low unemployment is neutral or maybe even negative for the stock market. And here is a great example of that. Here we have unemployment around 10%, and you can see that the market started to rally because the government stepped in. Another example of unemployment around 8%, and you see again market rallies because the Federal Reserve is working very hard on it. And the opposite example, when the unemployment is very low, we see the stock market declining. It's very interesting, I believe, and it's what every trader and investor has to know, because with our logic, we used to believe that when everything is negative, markets will continue to go to the downside. And when everything is positive, the opposite will happen. But in real trading and in real stock market, the thing doesn't work always that way. So we always have to come back to historical data to check everything and to see the real influence of real economic factor on the stock market and how the government responds to that economic indicator. Okay, it's another chart of unemployment rate. And again, you can see that we saw the highest unemployment rate almost at the end of recession, which is a great tool to confirm the end of recession is very close. The high unemployment rate, once again, potential sign of end of the recession. These gray vertical lines represent recession. You can see it almost every time. Here we had high readings of unemployment and end of the recession. Here again, high readings of unemployment, end of recession. The same here, and here again. So it's one of the most useful and one of the most reliable indicators to get ready to buy stocks and load your portfolios again. So here's a bit more numbers for you. Unemployment rate and S&P 500 analyzed returns. As you can see from this table, unemployment rate above 9% delivers the best analyzed returns of almost 25%. As unemployment rate goes down between 7 and 9%, it delivers the way lower returns, average of 15%, not so good return already. And another example, between 5 and 7%, the analyzed returns of around 8%. And the lowest returns of almost 4% we have when unemployment rate is below 5%. So that also helps you to be more realistic about the targets and be more realistic about how long you have to hold your stocks and what you can expect to get in return. You may ask, is there a way to narrow timing? Because yes, those indicators are working good, but when it comes to exact timing, there should be something better, right? At least we wanted to have it. So the good news, we do have tools that will help us with time. First of all, cycles. I believe that everyone is aware of how it works. It's just a timing tool that says that we are close to significant top or bottom in the market. But it doesn't give any hint regarding how strong the move should be or how long it will last. Just approximate timing. And the next two tools are most interesting. 13-week rate of change and ADA. So let's have a closer look at it. And here we have the S&P 500 chart and also 13-week rate of change, which is quite good timing tool, but not always, because sometimes it gives signals too early. But we can use the same ADX to filter the signals and thus get better buying opportunities and better timing. So let's have a look. Here we had first signal to go long. Well, it worked out almost immediately, right? Another signal to go long based on 13-week rate of change, another rally. And here, the COVID sell-off, we can see that this indicator gave signal much earlier, and we saw further decline in the market. But hey, at the same time, we had a signal from ADX, and ADX was telling that we are close to the trend change, but not there yet, because the ADX did not roll over yet. So we had to wait for that moment. Just use always few indicators with one purpose, to help you to filter too early entry. It doesn't work always like a charm, but in most cases, having few indicators to filter each other is a very useful idea. And as you see in this particular example, it worked very well. Another example is here. The 13-week rate of change almost reached the buy point, just a little bit missed it, but we got a signal from ADX. So when you combine them, you get better understanding of what is happening in the market, and you are not missing opportunities like this one. So the fair question would be when it's time to sell and when it's time to reload your portfolio. And this question is more difficult than when to buy, because it doesn't mean that the tools we are using to focus sell doesn't work so good. They do. The only reason is that market reverses to the upside much faster than it reverses to the downside. You get recessions, you have stock market decline. If you don't understand that's going to happen, then you are not ready. You won't do well in the market. And that is absolutely true. We are focused so much on our fear that market will continue to go to the downside, that some negative news will pull this market down hardly, and so on. But we miss the most important thing. We never have a real bear market without a recession. So maybe we have to focus our attention more on looking at fundamentals, looking at economic indicators to get better understanding when to expect the recession and if there is any risk of recession at all. Otherwise, we are still in a long-term bull market. And all the sell-offs are very short-lived and will create just another buying opportunity. So here are a few tools that are very useful if you want to focus and to have better understanding of when to worry about bear market and when not. The first tool is the probability, one of the focus of probability of the recessions. And when we have readings very high, usually it means that economy is in the danger zone and we can expect recession, which is not the case at the moment, at least as for now. Again, the probability of American recession predicted by Treasury spread. And this forecast gives us insight 12 months ahead. Can you imagine that? 12 months ahead, we can have a warning signal that recession is coming. Isn't it a good idea? And isn't government so kind to share this information for free? And as you can see, again, these highlighted zones are recession and high readings send us warning signal, again, which is not the case at the moment. Another interesting tool I believe that everyone has to use is ADS index. Also, it's available online for free. And the very negative readings around -3 or so send us warning signal regarding economy. And it's also one of the signs of we are close to recession. But none of that tools can cause, and none of that economic indicators can cause the recession. You can ask 10 advisors why 2008 crisis happened, and they all will give you different answers. And they all will be right only partially. Because in fact, the crisis and the recession happened because all those factors came at the same time, at the same place, if I may say so, and that's why recession happened. One indicator, one factor can't create recession, never. So it's always the mix of fundamentals turning negative. And I believe that everyone has heard that inflation above 5% is very negative for the stock market, for economy, and it's a sign of coming recession. And that is true, you can see from this example. But again, inflation itself can't cause the recession. There has to be a lot of other factors coming together and sending negative signals about the economy. So at the moment, we have really high inflation, but Federal Reserve, I believe, can handle that inflation using interest rates, which is the best way for them to control the inflation. So let's see if they will succeed in it or not. And I believe that the next two quarters will decide everything. Why next few quarters, I will explain a bit later. Another useful tool is chat spread. Again, the very high readings as negative for economy, but again, we use it only as the confirmational tool. We got negative signals from the mentioned before tools. And well-known yield curve, and there are some facts I would like to share about yield curve. Steep positive curve indicates investors expect strong economic growth. Sharply inverted curve means investors expect sluggish economic growth. Flat curve generally indicates investors are unsure about future economic growth. But I have more interesting fact about yield curve. Inverted yield curves have preceded 7 of the last 7 US recessions. Just think about it. There is no better indicator in the world. It has forecasted 7 of the 7 recessions. Isn't it amazing? So here's some data regarding type of yield curve and average return. So as you can see, the best type of yield curve for stock investors is positive and flattening yield curve, which gives the highest average return from 3 months, 3 years. And thus it is the best one if you want to go long stock and you see the positive and flattening yield curve. That is a very good moment to buy stock. So here are some examples from the past to show you how actually it worked out. This is a great example of almost immediate reversal to the upside in the market with a positive yield curve, and any readings between 0 and 2% is considered to be the best time to buy stock. And that is what is happening with negative yield curve. And as you can see, it took quite a lot of time for yield curve to stay in negative readings before we saw the decline in the stock market. So that was what I mentioned before. It always takes a lot of time for the negative cause to bring the market to the downside. It never happens very fast. It never happens because of some negative news. It always happens because of set of negative economic factors playing together. And there is another great way to use yield curve, and especially if you like to use more active money management and asset allocation. So when yield curve is below 0, you want to look for bullish setups in commodities and gold. It doesn't mean that you have to start buying commodities and gold right away, but you want to pay close attention to them. And in case there is a bullish setup, you want to go on. When the yield curve is between 0 and 2%, look for bullish setups in American and even foreign stock market. And finally, when the yield curve is above 2%, look for bullish setups in bonds. Again, doesn't mean start buying right away. Look for good, strong setup. So another indicator I want to share, it works only on a very long-term basis, and it doesn't give signal very often, but I want you to be aware of that. Because when it delivers signal to go long, they're just amazing buying opportunities. And we will see the rally for the years and years ahead. So probably one of the best long-term bullish indicators of the stock market. It has quite a very long name: non-financial corporate business, corporate equities, liability, level plus domestic financial sectors. You can find this information also for free on the Federal Reserve website. And the best buy zone is when we have readings below 0.25. And the greatest point is if we have recession during that time. And in most cases, we do have recessions when this indicator shows this reading. Readings above 0.45 is a kind of danger for the stock market, but it's not a signal to go short or to close all your portfolio and book profit. It's just something that tells you that, hey, you have to go and check everything, what is happening with the economy right now, to see if there are signs of recession. Okay, so the first question will be, where are we now and what to expect next? To be honest, as I said, the next 2 quarters will be very important because we have 2 interesting crosses in the cycles this summer, and the more important one this October, that indicates very good buying opportunity in the stock market. So the key question remains, if at that time all the economic indicators I have mentioned will be in a positive territory without sending any warning signals about recession, we are quite safe and we can go long at that time and make some money on the buy side. If at that moment we will see a lot of signals that recession is coming, I believe that then we have to pay special attention to the cyclical tops in the market and start going short. But as I said, at the moment, there are not a lot of those signals sending some danger signs to us. So we are quite safe and likely we will see buying opportunity this autumn. And one of the most frequently asked questions I get on events like that is the money supply, how it's dangerous for the economy in the stock market. So I don't know if today is going to be such questions, but anyway, if you wanted to ask, I will reply right now. So it's believe in that conditions for quite a long time, and the stock market is quite strong, hitting new highs even with these levels of money supply. So I believe that when it comes to money supply, it's more important to see what is surrounding that money supply, to check the population growth, to check the spendings, check GDP, and maybe that money supply is not that dangerous at all. So you always have to look at the bigger picture, not just focus on one economic factor and think that it will be the end of economy or something like that. Always look at the bigger picture. So now we have few minutes to answer your questions, if any.
Yeah, we did have a few questions, and it's nice that you touched on that just now, actually, because we did get one asking, based off of your research, when you think the next recession would occur.
Well, at the moment, we don't have any signs of recession. And as I said, if the mentioned indicators will stay on a positive territory, I will be buying this year, but later, maybe like normally it would take at least 2 years from now for recession to develop. I don't know what might happen that that global, some global event that could bring it much faster. But I don't have such an event on my mind. I can't even guess what it might be. So for this year, I believe that there will be no recession, and I believe that cyclical bottoms will work very well.
Thanks, Ina. Now, this question from John is from a little earlier in your presentation, asking, would narrowing timing include doing trades with sooner expiration dates?
Well, expiration, in fact, it doesn't matter mathematically for the trader because you can roll over your futures and mathematically it means nothing for you. So it's just some psychological more trap for the traders to avoid expirations and so on. And for the shorter term trades, we can use also other indicators like the same advanced decline line. It still works good. And the accumulation. There are a few indicators of accumulation that works very good in combination with advanced decline line and also the short-term cycle. So if you are the short-term trader, then pay attention to advanced decline line, money flow indicator, accumulation indicators, and short-term cycles. And you will do quite well.
Thank you, Ina. And another question we have from William is asking about your favorite sectors to buy right now.
Right now, I am not actively buying. I do have some stocks, and all of them at the moment are from Dow Jones Industrial Average Index. I have 5 stocks from that index at the moment. And big buying for me will happen maybe in the middle of this summer or more likely in October this year. And I will be looking at more sectors and especially at energies, healthcare, and at some supermarkets like Walmart. It's very good stock to buy from time to time, by the way.
Thank you. And on that note, still speaking of economic indicators, what are your thoughts on buying commodities right now?
Well, we had great buying opportunities in commodities, but they have almost passed. And I don't know what kind of COT report we will get this weekend, but I wouldn't be surprised to see bearish reports in the coming few weeks and the reversal in the commodity. So at the moment, I don't think that it's a good time to buy commodities. I have been buying wheat recently and it worked well. As you likely noticed on the chat, I didn't even expect that high prices. But I believe that we are quite close to the end of the rally and the market will roll over.
Thank you. And we have another question from Adrian. They're asking, they say, often when someone emigrates to North America, as I did, it is easy to see the errors of people's perception towards Europe. If any, what kind of errors do you see?
Well, I didn't notice anything like that. And, I have such active style of life. I travel a lot and I communicate with the people from absolutely different countries. At least when it comes to business, when it comes to markets, I didn't notice anything like that. And talking about current situation in Europe, I believe that in some way market is getting used to that situation, and market never reacts on the same news with the same strength. And I believe that what is happening right now in Ukraine and in Europe will just become not an issue for the stock market with some time. I don't want to sound terrible or something like that, but that's the reality how the stock market is functioning. There has to be something much, much worse for these events in Europe right now to cause some negative situation in American stock market.
All right, Ina, thank you so much. And to all the wonderful people in the audience, that does conclude our time for this session. So I want to give another huge thank you to all of you for joining us again today, and again to you, Ina, for that brilliant presentation. Be sure to check out moneyshow.com to view this presentation along with others from the show on demand. And I hope everyone has a great day.
Thank you, Charlene, for hosting me, and thank you everyone for coming to see my presentation. It's always a great pleasure to be on Money Show.